If you've ever looked at your bank balance and thought, I should be doing something smarter with this, you're not alone. A lot of people sit on cash for years, not because they don't want to invest, but because they don't know where to start. Questions pile up quickly. Is $5,000 even enough? What if the market crashes right after I invest? What if I choose the wrong fund? What if I'm already too late to see meaningful growth? These questions feel heavy, and they stop most people before they ever begin. But here's the reality. Investing doesn't require perfect timing, expert knowledge, or a massive amount of money. What it requires is a simple, repeatable strategy and the discipline to follow it over time. So let's start from zero and build this step by step. Before you invest a single dollar, you need to understand what you're actually buying. One of the most popular and beginner-friendly investment tools today is something called an ETF, or exchange-traded fund. At its core, an ETF is incredibly simple. Think of it like a basket. Instead of putting all your money into one company and hoping it performs well, an ETF lets you buy a piece of hundreds or even thousands of companies at once. One purchase gives you instant diversification. If one company performs poorly, the others help balance it out. You're not relying on a single winner, you're participating in the broader market. Now compare that to buying individual stocks. When you buy a stock, you're betting on one company. If that company does well, you benefit directly. But if it struggles, your investment takes the full hit. Over time, consistently picking winning stocks is extremely difficult, even for professionals. That's why many investors move toward ETFs. They remove the need to guess which company will win and instead allow you to grow with the overall economy. You might also hear about mutual funds, which sounds similar to ETFs because they're also baskets of investments. The key difference is that mutual funds are usually actively managed. That means a fund manager is making decisions about what to buy and sell. While that sounds helpful, it comes at a cost. These funds often charge higher fees, sometimes over 1% per year. That might not seem like much at first, but over decades, those fees can eat away a huge portion of your returns. ETFs, on the other hand, are typically passive. They track an index and require little management, which keeps costs extremely low. Lower costs mean more of your money stays invested and compounds over time. This brings us to the first rule of building a strong ETF portfolio. Always check the expense ratio. This is the annual fee you pay for holding the ETF. Even a small difference in fees can have a massive impact over 20 or 30 years. A fund charging 0.05% is far more efficient than one charging 1%. That difference might seem tiny today, but compounded over decades, it can mean tens of thousands of dollars in lost growth. The second thing to understand is what the ETF actually holds. Not all ETFs are the same, even if they sound similar. Some track large companies in one country, others track global markets, and some focus heavily on specific sectors like technology. Before you invest, you should always ask one simple question. What's inside this fund? Knowing this helps you stay confident during market ups and downs. When you understand what you own, you're far less likely to panic when prices drop. The third factor is track record. While past performance doesn't guarantee future results, a long history of surviving different market conditions tells you something important. Funds that have gone through recessions, crashes, and recoveries show resilience. They demonstrate that the underlying companies and the structure of the fund can withstand real-world challenges. That kind of consistency matters more than short-term performance. Now let's build a simple portfolio using these principles. Imagine you have $5,000 to invest and you want a strategy that balances growth and stability. Instead of trying to pick individual stocks, you divide your money across 3 ETFs, each with a clear role. The first ETF represents stability. This type of fund tracks large, established companies in a major economy. These companies tend to be leaders in their industries, with strong financials and long histories. By putting a significant portion of your money here, you create a solid foundation. This part of the portfolio isn't about explosive growth, it's about steady, reliable progress over time. The second ETF focuses on growth. This fund leans heavily into innovative and fast-growing sectors, particularly technology. These companies often expand faster than the broader market, which can lead to higher returns. However, they also come with more volatility. Prices can swing more dramatically, especially during economic uncertainty. Adding this ETF to your portfolio increases your potential upside while still being balanced by your stable core investment. The third ETF adds global exposure. Instead of focusing on one country, this fund invests in companies around the world. Different regions perform differently at different times. By including international exposure, you reduce your reliance on any single economy. This diversification helps smooth out your returns over the long run. With $5,000, a simple allocation will look like this. Half goes into the stable core ETF, around 30% into the growth-focused ETF, and the remaining 20% into the international fund. Each piece serves a purpose. Together, they create a balanced portfolio designed to grow over decades. Once your portfolio is selected, the next step is actually buying it. This is where many beginners hesitate, but the process is much simpler than it seems. First, you open a brokerage account. This is like a digital platform where your investments live. The setup usually takes just a few minutes. You provide basic information, link your bank account, and you're ready to go. Next, you transfer your money into the account. This typically takes a couple of days. Once the funds arrive, you're ready to invest. Before making your first purchase, there's one setting you should turn on: automatic dividend reinvestment. Many ETFs pay dividends, which are small cash payments to investors. Instead of letting that cash sit idle, reinvesting it automatically buys more shares. Over time, this creates a powerful compounding effect. Finally, you buy your ETFs. You search for each fund, enter the amount you want to invest, and confirm the purchase. That's it. You don't need thousands of dollars for each share because most platforms allow fractional investing. Even small amounts can be invested immediately. Now comes the most important part, and it's also the simplest: doing nothing. After building your portfolio, your main job is to leave it alone. Markets will go up and down. There will be periods of growth and periods of decline. This is normal. The biggest mistake investors make is reacting emotionally, selling during downturns, or constantly changing their strategy. Instead, focus on 3 habits. First, hold through market drops. Every major downturn in history has eventually been followed by recovery. Investors who stay invested benefit from that recovery. Second, let your dividends keep reinvesting automatically. This builds momentum quietly in the background. Third, review your portfolio once a year. If your allocations have shifted significantly, you can rebalance by adjusting your investments back to their original proportions. Over time, this simple approach can produce powerful results. A one-time investment of $5,000, growing steadily over decades, can turn into a substantial amount. The early years might feel slow, but that's how compounding works. Growth builds gradually at first, then accelerates over time. By the second and third decades, the impact becomes much more noticeable. For those willing to take on more risk, adjustments can be made. Increasing exposure to high-growth sectors can boost long-term returns, but it also increases volatility. This means larger gains in strong markets and deeper declines in weak ones. The choice depends on your comfort level and time horizon. In the end, investing isn't about finding the perfect strategy. It's about starting with a solid plan and sticking to it. You don't need perfect timing, and you don't need to predict the market. You just need consistency, patience, and a clear understanding of what you own. That's how small amounts of money, invested wisely, can grow into something meaningful over time.